Let's connect with Rhythm Desai, Managing Director of Morgan Stanley India. Rhythm, morning. Always delight to have you back on ET Now. Rhythm, the outlook for India is weak. Nobody wants to invest in Indian equities. But if I look at the response what Morgan Stanley has got at their Morgan Stanley annual conference, I'm a bit surprised there. Are you also surprised with the kind of investor interest or the kind of participation you've got?
Yeah, Nikunj, actually, I must admit that I'm also a bit surprised. We've got record attendance, both from investors as well as from corporates. Investor attendance is running at around 425, which is higher than last year. And if you'd asked me this question, say, a month ago, I wouldn't have actually made this forecast. So certainly investors have showed up. That doesn't mean that investors are out to buy the market. I think there are various sorts of investors who are seeking updates on existing portfolios, who are fishing around to find out what's happening to companies. There's a lot of interest in companies. We have a lot of companies which have meeting requests close to 100, and that's a lot of meetings that people are seeking with companies. And there are others who are maybe looking around to buy some stocks if they come off in the next few days or at current levels. So it's a mixed bag. It doesn't necessarily signal that people are bullish. What it signals is that India is not a totally lost case as far as investors are concerned, and there is deep interest in India.
Rhythm, hi, morning. Are investors now asking you tough questions? Are they worried about their India exposure?
And investors have been asking these questions for a while now because we've gone through a very tough period in terms of economic performance. Inflation has been high, policy momentum has been weak, growth has been slowing down. So these questions have been coming, but you're right. We've seen, I would say, a lot more questioning on downside risk. I think people have become acutely aware that things can actually worsen from here. And we may not necessarily be at the low point of macroeconomic performance. The fact is that we are running a very high twin deficit. The fact is that the world is not in the mood to finance that. The fact is that we could be heading into some event risk in Europe which could cause a freeze in funding, and that could have impact on India. Indeed, people are also asking about the monsoons, whether, is there a case for that to fail and what impact that could have. And of course, the usual stuff on, when do we see a recovery in policy momentum and when do we start seeing things like fiscal consolidation, diesel price hike. So I think all the questions are geared towards, can this get worse from here? And there's less focus on how it's going to get better.
So Rhythm, at a time when earnings have been mixed, global macro is challenging, what makes you so bullish on Indian equity valuations?
Yeah, see, the macro is not good. Okay, that's a given. I'm not going to add any value to anybody's life by telling you that the macro is bad. Earnings outlook is fuzzy. Really, I cannot peg the number with great confidence. Maybe earnings are 5%, 8%, or maybe they get to 15%. I mean, my forecast is that we'll get 15%, but it's not a forecast with a great deal of confidence. But what I know is that stocks are cheap. And when I say that, I usually use a price-to-book measure because there's a lot of cyclicality associated with earnings. So when earnings are troughing out, on a PE basis, they may not look as cheap as they ought to because earnings are actually in a down cycle, like we are right now. So the way you overcome that is by measuring valuations on a price-to-book measure. And if you take the broad market, the price-to-book is around 1.1 times. The last time we got to that level was, of course, the Lehman crisis, and before that, which I would consider the Lehman crisis as a one-off thing, and valuations were very briefly there, they were not there for too long. Before that, you go back to 2003. Now in 2003, the macro was in arguably a soft state. India was going through low confidence on earnings. But we know that if you bought stocks at those levels, you made a lot of money. And we can test this going back through various cycles in the past, that when valuations reach their bottom decile, by the way, they've not got there as yet, they're about 10% away from there, the degree of confidence you can have on forward returns can be very high. On an average, you make about 40% returns. with a very high probability, close to 95%. So we are very close to that point, and of course I don't know whether we get there, and maybe we get there, and maybe we even go lower, because it's hard to forecast the course of events. But I think there's an element of safety that's building up here, and what we are guiding investors to is, start using your ammunition, start buying stocks, keep a little bit of gunpowder in the barrel, and if things turn adverse in Europe, and if stocks have to fall, and presumably they'll fall everywhere in the world, India will not be an exception, I think you will get opportunity to buy it at lower levels, so you keep that bit of ammunition in the gun. But otherwise, this is the time to start buying. So that's how I'm looking at this market.
So time to buy, time to shop, load up, back up the truck and start loading it. Rhythm, now that you've made a case that it's time to buy Indian equities, let's talk sectors, themes. Where are you advising your clients to put their money to work?
See, the challenge, Nikunj, about that is that we are still not ready for sector bets. We're not ready for making big sector calls. We're not ready to make a big macro call. So we're still very focused on picking stocks. The correlation of returns is still high. The dispersion on earnings growth and valuations and on fundamentals is also very high. So given that situation, it's actually ideally set up to be a stock picker's market. So really the focus is on stocks. Within that, I think mid caps are actually giving you the best deal. So I would be focused on buying mid and small cap stocks. I think a lot of large cap stocks, especially what we classify as quality large cap stocks, are actually not cheap. And they are not the place where you want to actually put money to work right now, given how much cheaper you can buy stocks down the cap curve and without sacrificing quality. So I think that's where my focus is.
Rhythm, what's your view on the index? And do you think it's time to get into sectors like power, infra, which have been really beaten down?
See, I think the time to make the macro call, which is, what I call as the nifty call, is when the correlation of stocks actually drop. So we're somewhere between the high point and the low point today. We're not at the high point, we're not at the low point. If that correlation goes down, and what that tells you is that there are more idiosyncratic factors that are affecting stock returns. And when you get that piece of information, you know that it's time to make a macro call. Now, which direction that macro call is very hard for me to tell you now, because I don't know what the index will be then. Maybe the index is 4,500 and maybe it's a call to actually buy the Nifty. Maybe the index has already gone up by then and we may not be buying the Nifty. I don't know that. But that's the time when I would actually venture out to make big sector calls. Right now, it's not the right moment to make big sector calls. So we're still focused on picking stocks.
Rhythm Desai, final question. So what is your big call for FY13?
The big call, I think, is that I think the market should do much better in the next 12 months than it has in the last 12 months. And both in rupee terms as well as dollar terms.